Good afternoon, everyone. I am Claudia Duran, Managing Director of Endeavor in Miami, and I would like to welcome to our Investor Relations Fireside Chat. I'd like to thank our sponsors, Dell Technologies and Ernst & Young, for making this session possible to our audience. I hope you all enjoy it. But first, I would like to welcome Sylvain Dominici, partner at EY, and Gina Baidia, program manager at Dell Technologies. And Dell for Startups, thank you and welcome. Do you have any, Gina and Sylvain, advice before or any words you would like to share with our audience before we kick this um, masterclass and fireside chat before it begins? Let's start with Gina.
Yeah, of course. Hey guys, my name is Gina Vega. I'm a program manager at Dell for Startups. I'm excited to partner with Endeavor here within Dell for Startups. Just really briefly, what we are as a program, we are a dedicated IT service to help startups and entrepreneurs scale their IT everywhere from your first computer all the way to your entire IT setup. So if you ever have any questions about anything from what you can use or how long it will last you in this current IT climate, we do have free consultations with our Dell advisors. And we also participate on a local level with our communities, as for example, this masterclass, as well as entrepreneur centers and pitch competitions. So feel free to check out dell.com/startups for more information.
Yeah, Dell has been a great partner of Endeavor in Miami, so we're very happy to have you and as our partner in many events and opportunities that we're working together to support our entrepreneurs. Same that we're doing with EY for several years now. So Sylvain, anything you would like to share?
Yeah, thanks, Claudia, and good afternoon, everyone. My name is Sylvain Dominici. I'm a partner at EY. EY has been a partner for Endeavor for quite some time, particularly the Miami chapter. We've been partners since inception. So we're thrilled to be able to help Endeavor support the local entrepreneur community. EY is a global consulting firm. We offer a very wide range of services, tax, audit, consulting, transaction strategy, et cetera, et cetera. So we have a lot of people that are very talented people that know a lot and that are experts in very specific domains. And then we help our community to kind of leverage that expertise to solve the most challenging questions that entrepreneurs and corporations have to deal with. EY has been a great supporter of entrepreneurship and believes in entrepreneurship as a key element of our economy. So we thank you, all the entrepreneurs on the line, for being, such dynamic, vectors of economic growth. EY has been, recognizing the power entrepreneurs for many years. We've got programs in particular like the Entrepreneur of the Year program, which has been running for 36 years now. And similar programs such as the Entrepreneurial Winning Woman and the Entrepreneur Access Network, focusing on women entrepreneur and then Black and Latinx entrepreneur on the other side. So we're thrilled to be part of this masterclass, and we wish you a great learning experience.
Excellent. So many opportunities from both of you. So thank you again for your support, Sylvain and Gina, through Dell for Startups and EY, for partnering with Endeavor, and for making this presentation and conversation actually between Sanket and Jackie possible. I hope our audience learns a lot today and takes a lot of, gets insights and takeaways for their own journeys as entrepreneurs or investors. So before we get started, I would like to introduce our growth program manager, Rebecca Negro Rocha. She will be your host for today. And you're in great hands. I leave you with Jackie, Sanket, and Rebecca. Enjoy, everyone. Take care. Have a great afternoon.
Awesome. Hi, everyone. As Claudia mentioned, I'll be the host of the Fireside Chat today. So before we kick things off, I would like to introduce you to our incredible guests. So to start, we have co-founder and CEO of Boatsetter and Endeavor entrepreneur Jaclyn Baumgarten. Jackie is an incredible founder, having previously been selected to Inc.com's Female Founders Top 100 list, propelled Boatsetter to become one of Fast Company's best workplaces for innovators, and a top 100 marketplaces ranked by Anderson Horowitz. And last but not least, her strong leadership has led Boatsetter through a $38 million Series B round. So welcome, Jackie.
Thank you.
How are you?
I'm great. How are you, Rebecca?
Good. Thank you for being here. I'm super excited. This is going to be awesome. So now I'd like to introduce to the audience Sanket Parekh, managing partner at Secocha Ventures. Sanket was born into a business family, which allowed him to learn about commerce and trade from a very young age. He has broad experience in sales, marketing, operations, supply chain, corporate strategy, and M&A, both in India and in the US. In 2013, he founded Secocha Ventures, an early-stage venture capital firm focused on finding and backing the next generation that's disrupting the status quo. In the past 7 years, they have backed over 60 companies in the US, India, France, and Israel. And I'm super happy to say that he's an Endeavor mentor. So welcome, Sanket.
Hi.
Hi, welcome.
Thank you. Nice to be here.
I'm so glad the two of you are here doing this with us. I can't think of two better people to do this with our founders. So before we get started, are you ready? Do you have anything to share with the audience before we dive right in?
No, let's dive right in.
Let's kick it off.
Awesome. So I'm gonna, for the audience, you guys are not gonna see a lot of me because these are the stars of the show today. So I am gonna pass it off to them in just a second. The topic today is investor relations. So we have some topics planned out for this conversation and some questions, but the idea is for this to be a conversation between Sanket and Jackie. So with that, I will turn to Jackie to kick things off with the first question, and we go from there. Okay?
Awesome. Thank you. All right, Sanket, you ready?
Yes. Let's
So,
roll.
given that you are an investor focusing in early stage companies, I am assuming you're going to see a lot of first-time founders.
Mm-hmm.
What would you say is the biggest misconception that founders have about investor relations, in particular around building and maintaining relationships with investors?
It's a good question. I think a lot of folks have been exposed to the worst side of these kind of relationships and not enough of the good side. Again, because it's, the worst ones are more scandalous and more likely to be clickbait. But the relationship with investors can really be quite meaningful and fruitful. And I'd love to hear your thoughts on it also, given the fact that you've been through so many rounds. But I think the biggest misconception is to treat investors as potentially folks that you need to be wary of. I think as is with any other industry, there are good ones and bad ones. I think finding folks that are kindred spirits is far more valuable than the 5 million additional valuation that you might get in your Series A from someone who's not a kindred spirit. One of our early bets recently raised a Series A and had two options of tier one investors to lead their Series A. One was at a $40 million valuation. The other one was at a $45 million valuation. The founders spent a few days with each of them to really get to know the partners at each of these firms, and eventually ended up with the $40 million term sheet because she said that I jive better with that partner. And kudos to her to value the long-term impact of that versus the $5 million impact on valuation at a Series A. So I think long-winded answer, but I think it's all nuanced. I think all my answers are going to say that, but it's about finding that nuance for yourself.
Yeah, if I can add on to that, Sanket, as a founder who has worked with many, many investors, that advice is as sound as it gets. I think too many early stage founders get so caught up and focused on valuation but that's a secondary or tertiary thing that they should be focused on. The most critical thing is ensuring that the person you're bringing to the table with you as an investor is aligned with the vision that the founder has, and that you have a shared common interest in where that company is going, because that's how you're going to have an ally long term. And there are undoubtedly going to be challenges and unexpected hiccups in the business model, macro issues that you didn't anticipate. And if you and your investors are not aligned on what you're trying to accomplish, it's just going to create heartache.
Exactly. So how has that evolved for you? As a founder now who's been doing it for a few years, you've been through multiple rounds, you've been through multiple conversations with, I'm assuming, quite a few investors.
Mm-hmm.
How has that, A, the relationship itself, but B, your own view of this engagement with investors, how has that evolved over time?
I think being very thoughtful about making sure that where you are and where your company is in its life cycle, that you're reaching out to the right stage investor, because the prioritization and the focus of investors varies depending on the stage. Are they seed investors, angel investors? Are they venture investors? Are they PE investors, growth investors? And I've now raised from all of the above. And I can tell you that the priorities of those investors are different. And so that means that you have to make sure that where you are in your business plan, where you are and your path to profitability is aligned with the investor that you're targeting at that time. I hope that
And how did that? Yeah, it does. It does. And how did that change your pitch? So let's say going back to day one, pitch one, the strategy that you may have used at that point of time, how was that compared to the most recent one you ever did? And how did that change your ability to get your foot in the door?
Yeah. So let's talk about how the pitch changed. I think initially, when you don't have a tremendous amount of traction and data to share and put forth, the investors are investing in you and your vision and their confidence level in your ability to lead and execute and build out that vision. And so a lot of the initial pitches are more aligned with what one plans to build, rather than being able to point to proof points, both from, financial proof points, strategic partnerships in place, and the traction that you're going to need at later stages. So it's more vision and storytelling and connection and credibility that you build as a founder with the investor. As you get to Series A, it's a game changer. You need to know your business inside and out, and you need to be able to put forth metrics that shows that you've de-risked your model and your business in its space, be able to articulate what unique moats that you've put in place to make sure that your company is going to win above others and competitors in the space. And you have to be able to point to product market fit and traction. And that only intensifies as you move towards growth. At that point, you need to be able to show that you have, in my case, with a marketplace, we look at unit economics and we look at our ability in a market to be able to drive liquidity between demand and supply, and being able to convince the investor that we know how to launch and build a market, but with this capital, we can cost effectively apply it to new markets. And it's a rinse and repeat model. That's a very different pitch than when you're starting out in your seed or your Series A. The other thing that shifts dramatically, especially in this market now, is the level of diligence. It's blown my mind in this last raise in the last 6 months. The level of due diligence is unlike anything else I've experienced in any prior raises, to the point where third-party companies and consultants like Deloitte and Touche, McKinsey, are brought in to evaluate our go-to-market strategy. Deloitte looks at our financial documents and plans. You have CTOs that are hired from other companies to look at the tech stack and to see how we're structured. So the scrutiny escalates significantly as you move into later stages.
Got it. So, I think given, I'm assuming given our audience is going to be a little bit more driven towards early stage.
Yeah.
So, sort of shifting gears back to maybe year one for you, what was the cold outreaches like for you, and which ones worked, which ones didn't work?
Yeah, it's a brutal process, no matter how you look at it. And I think early on, I learned very quickly not to send my deck or my pitch deck in advance. That's a rule for me. I want to control the narrative because early stage, the investors are investing in you and your belief and your vision. And the confidence that you can instill. And if you send your entire pitch deck with your financial plan, all you're doing is setting up preconceived notions for them to poke holes in why this won't work. And so once you get the meeting, they're not listening as well as they should be. They're thinking about the slides that you've provided. So early on, I think the lesson I learned was control the narrative and make sure you just get the first meeting. And then it's up to you. Because then when you're face to face with the investor, like you and I are, I can read your body language and see what areas you're questioning, where you want to learn more. And being able, by knowing your business well enough, you can adjust to any investor based on where they want to go with the business, what competitive advantages you claim you have that they want to question. And that dialogue and being able to move, ebb and flow and move right or move left, depending on who you're talking to, helps build that trust and credibility. And then you support it with the deck.
I think the analogy I tend to refer to this as the same thing as you would go about with your customers, right? So there's a funnel process to it where you need to have your top of the funnel wide enough to be able to capture as many leads as possible, but then how do you sort of walk them through the funnel? And what I have found working really well is where you end up with a teaser, whether that's a one-pager or whether that's a short deck. That's just a teaser. That's not really getting into the business in a great extent, but actually giving you a bite. And then the next conversation gives you a bigger bite. And then there's a leave behind that gives you an even bigger bite. And that leads to a fourth point of contact, a content. And so the funny thing is, this is exactly the same process that I would apply with my LPs. It's, the way founders go about raising for themselves as a fund manager, I also have to go through the same process. I don't think the founders appreciate that aspect of it enough. As a fund manager, you have pretty much the same process. So there is a lot of empathy with early stage founders who are doing it probably for the first time or the second time. We're going through the same stuff, right? We just raised a second fund, and it was 100 times better than fund one in terms of the process because we learned from it. But it's the same thing. It's about not giving up your deck too quick, making sure that there is enough of a bite at the first point. But the other thing also that I've sort of learned in my fundraising process, which I think it applies to founders also, is before you actually pitch, ask questions.
Yes.
To validate whether in this case I'm talking about LPs, but in a founder's case, talking about the fund manager, is this the right person to even pitch to?
Absolutely.
We see founders basically blinkers on, getting really strong on pitching what they are good at, their business that they're working on. But sometimes it's worthwhile just taking a pause and looking around and recognizing, probably not the right person to pitch to in the first place, because I'm building a B2B business. This person does no B2B investments. Absolutely. I'm at pre-seed stage. This guy does not do any investments in pre-seed stage. And this whole thing about, spray and pray versus, targeted, very methodical pitches. And I think that's where a lot of the, concerns around not getting enough conversion or not getting enough bite from investors disappears to a certain degree. Obviously, there's always still a lot of work to do, but at least you're now pitching to people that should be within your scope of what your product is. So that's an interesting angle from my end.
Yeah, I'd like to add to that. So I know we're going to be talking about the process, but I'll jump in. I am maniacal about maintaining my own CRM. And the first thing I do when I get on the phone with an investor is I ask them questions. Some of the questions that I ask are, where are they in their fund? Where are they in the life cycle? Because as a founder, especially early stage, you don't necessarily want to take money from a fund that has only 1 or 2 years left before they have to return cash to LPs, because sometimes that can yield them forcing a sale or behaviors that aren't necessarily in the best alignment for the company. Number two, I ask them about the investments that they've made, what industry, what segments, to make sure that I am talking to the right person and the right fit. And then they have a playbook of what they look for. They know if they need to see a minimum of X million dollars in revenue. And you can ask these up front to gauge whether this is somebody right in your strike zone and you should go deep, or you have a nice introductory call, you start a relationship and realize we'll probably be ready for them in 12 months' time. And so let's not waste a full hour of each other's time. As a founder, this is the one thing I wish I had been better at early on, which is being fiercely protective of my time, because your energy is your most valuable resource, especially when you're out fundraising and running a company and you're burning the candle at both ends. And fundraising can suck up an immense amount of time. And so being almost surgical in how you go about it is going to help with your efficacy and your conversion.
And the other thing is also when you gather this data, you've now become a little bit more focused on who to speak to and when to speak to, and not share too much information about yourself. The reality is, just as you have a CRM, I have a CRM. Mm-hmm. And every single person I speak to is logged in there. Recently, we got an email from a co-investor who said, "Hey, I'm looking at this deal. Do you want to take a look at it along with me?" And in 30 seconds, I was able to pull out a deck from the same person 4 years ago. Because it's in my CRM. I'm not gonna, no conversation I've ever had is not logged in there, which means effectively I have a full track record of every single person's pitch, deck, conversation, whatever, and minutes of those calls that we put in. So effectively you're leaving behind breadcrumbs. And so you have to be conscious of the fact that which breadcrumbs do you want to leave behind and which ones you don't want to. So for example, what you just said is very valuable. The minute you realize that they are in your sweet spot of industry, and et cetera, but not stage, leave a breadcrumb. But don't leave a full-on loaf of bread. Leave a crumb. Like leave enough that keeps them engaged to continue the conversation. The other thing I found, and I think we're going to jump around on the questions, which is fine. I think it's a conversation, right? So one of the things I like a lot is engaging with founders between rounds, because I find that they are less under the pressure, more honest, more vulnerable, and just overall more genuine. And that gives you a perspective of, who is this person? Because in reality, as you just said, we are backing the founder. At a pre-seed and a seed stage, you're backing the founder. So you really want to get to know the founder. And the best way to get to know the founder is not when it's peak fundraising moment for them, because they are under a very unique kind of a pressure. And so, we've sort of also built this passive review pipeline where, these companies are not raising right now. We like what they're working on. We like the founder. And so we keep a tab on them. We'll maintain conversations with them in between rounds. We'll ask them to give us their sort of progress updates. Because what that does is that goes into a CRM. We are able to log those progress updates. And then when it's time to do a round, the decision-making doesn't take time, because we've been looking at them passively with, some valuable data coming from them that allows us to jump on a decision, or in fact, get engaged a little bit earlier also. So I think those are unique opportunities to really build relationships with the ones that you think can be valuable in the future.
Agreed. So Sanket, we're talking about once that process has already engaged and initiated. I want to take it back for those first-time founders who are just trying to wrap their heads around, how do I get that first meeting? So my question to you is, what is your preferred way as an investor to be contacted? And what are the nuggets that you're looking for that would lead you to say, I want to meet with this person?
Yeah, so, I think everyone says, let's talk specific numbers, right? So last year we looked at around 860 odd companies that hit us in our pipeline. Which means we've either seen a deck or we've had some content come from them. Of those, we ended up investing in 12. So the funnel narrows very quickly. And the ones that actually progress really well are the ones that are, 40% of the deals that we look at is coming through warm introductions. and maybe another 30-35% of the deals cold, and the balance are outbounds, where we've made the outbound to the founder based on either the network effects that we've had.
Mm-hmm.
The warm ones, we will meet with everyone. So that's a really good way of standing out, is probably speaking to someone who's either worked with this. So this is part of the due diligence that the founder has to do, right? So if you want to target a particular investor, you should speak to someone who has taken money from them.
Yes.
So that you can actually validate whether the investor is a decent investor or not. That's fundamental. And if you're doing that, you automatically have a warm intro now. Because I reached out, let's say, Jackie, I reach out to you and say, hey, Jackie, I saw that you took investments from XYZ Ventures. How are they? And I'm sure if a founder reaches out to you, ask you a pointed question like that, you would pick up the phone or have some level of engagement to be able to give your feedback on it. And so if that's the case, then you've automatically got Jackie now as a potential warm introduction. And that becomes very meaningful because those will rise above the pile for us immediately.
Agreed.
On the cold ones, we have a couple of cold ones that have sort of been on our pin board as that's the way to do it. And the founders have done full research on us. They've looked at all the companies we've invested in. They've read our blog posts. They've understood exactly how, because when we put out a blog post or we comment on any of our new investments, we are stating why. That's the key thing, right? So if you can lean in on that why and make a pitch email that's targeted to us based on the fact that, here's the reason why we fit you and you fit us, and a thoughtfully crafted email will stand out. We look at every single email that hits our inbox, and that's a lot, but we will. We will not respond to all the cold ones, obviously, just because the volume makes it impossible. But we have a process where if they ever get through triage and they hit level 1, which means we will have a call with them. Each and every level 1 engagement receives either if it's a pass email, they'll receive a pass email with thoughtfully, written out reasons why, because we don't want to just say no for the sake of saying no without giving clarity on why because we believe as early stage founders, they're looking for some insights to tailor their pitch a little bit better for the next one, even if we are not the one. And so we take the effort to give those responses on level 1 engagements that we have.
Mm-hmm. Very wise advice about shaping your outreach message to what that particular fund looks for and why they make the investments that they do. And I agree with you about the hierarchy of warm intros. I definitely think there is a hierarchy. My experience, the number 1 intro is either from a founder that they have successfully invested in and had a positive experience with. Mm-hmm. And then you may have a lot of these ancillary service providers, lawyers, whatnot. And I think that's a far second tier type warm intro. For what it's worth, so I don't get 1,000 emails asking for intros, I will say this: I will always take the call to provide feedback on a particular investor. But because I take my reputation so seriously, I do not recommend companies that I don't know well or founders that I don't know well.
Exactly. So that's the filter, Jackie. You are the filter for that fund now. Mm-hmm. That's why any recommendation coming from you is going to go up on the pile because, okay, look, Jackie's looked at it and she's not going to put her reputation and her relationship with us on the line by recommending something that's not fitting her basic, at least qualitative filters. So to that point, we quickly recognized that our single biggest ambassadors out there are the founders that we've invested in. And so we actually created a program called Secocha Founder Circle, where every single founder that we have invested in gets equity in us. Now they have a financial interest in my success, which means they lean in that much harder on leads and qualifying those leads versus just randomly sending it.
Absolutely brilliant.
It's done wonders because
that.
Yeah, and a lot of people ask us why haven't others done it, and I think it's because the partner has to give up equity, and when you have a very large partnership pool, everyone has to give up equity, and then everyone starts sort of hesitating on that. For us, this was a day 1 phenomenon for us. This is the way we established ourselves, and so it just worked for us. But the results of that are astounding. We invested in one founder out of Wharton, and suddenly we got 10 qualified leads coming out of Wharton in 6 months. And that's because the founder now is like an evangelist and ensures that any consumer tech business that she comes across hits our desk after she's qualified it. And so suddenly, people ask, where's your deal flow coming from? It's the founders.
I hope there are several funds that are listening to this that take heed and follow in your footsteps. I hadn't heard that before. The closest thing is there is a fund that's invested in me, and they tend to only open up to very large family offices, but they were willing to allow sort of lower cash point entries for the founders within the portfolio to participate, but it wasn't given as equity. And
so there is absolutely zero cash contribution by any founder. The minute we give them our investment, they immediately get a stock in us. And that is and it's fully vested. So there's no vesting schedule. There's no expectation from them. Everyone is equal, and it's just worked for us.
That's brilliant in terms of alignment of interest. I love it. What would you advise founders on avoiding in their communications with investors?
Don't put somebody else's name in the email that you write to me, because you're recycling these emails. Has that happened to you ever? It's such a common thing. You don't realize it because, and I feel for the founders, right? In the end, they think they need to broadcast at least 300 emails to potential investors to really get something. A lot of founders have started using mailing lists that are probably someone is marketing after scraping the web. Those things are not going to work. Yeah. Those barely get a look at, and we've clearly been able to now signify which ones are coming in through those channels and get looked at. So if you're not going to take the time to write or reach out in a meaningful manner, it's unlikely that you'll get a response.
It's true.
So that's really been our sort of biggest challenge that we've been able to identify so far. So, question for you.
Go for it.
Taking a step back, what's I'm sure you've had good meetings and bad meetings. As an investor that I'm meeting with, let's say I'm meeting with founders, what are the things that I should do and I should not do based on your experience?
So I think first off, you need to know your business inside and out and not be wedded to a script or a deck. I think founders often have an over-reliance on going through these slides in a pitch deck, and it's almost robotic. And it's nearly impossible to make a real human connection and be able to address the concerns or the interests that investor has. So that's first and foremost. The second thing is you really have to have a solid EQ, because this isn't just a numbers game. This is a human interaction. Let me take a moment and pause. I think going back to the need to be very protective of one's time, you have to get very good at being able to read body language and understand when someone is truly interested or they're not, and they're waiting for the time to just clock out. Because you need to know that most investors don't explicitly say no. And Sanket, you guys are masters at finding ways to redirect and basically say, come back to me when, and do everything to keep the door open and play into that hope. And in many cases, a lot of these founders have a sense and fear of desperation. So they lean in and hear what they think they want to hear. But the best thing one can do is be honest with oneself and know when a no is a no, even when it's not spoken. That would be advice that I wish someone shared with me earlier on, and a skill set that I wish I had honed faster.
It's not you, it's me. That's the standard approach, right? The reality is, let's be honest. If I and we have enough of these all over Twitter, right? Those past emails from people that are now being touted by unicorn founders as, look at this. And so obviously we don't want to be any one of those. And so we're conscious of the fact that every time we pass, we admit and we accept, and in our past emails, we will actually write that early stage investing is about, gaining sort of comfort quickly. And at this point, we weren't able to do that. It's honest, it's real. It's the fact that we're not trying to lie about it, and we also say that we would love to be proven wrong. We're happy to be proven wrong. So I think it's just approaching it with a certain sense of honesty.
I think it's the greatest gift you can give a founder. I will literally be effusively happy when I get a very clear and direct no. To me, it's the greatest gift you can give, and you can add the benefit of saying why you said no. Because that information is so valuable to a founder in terms of either shifting their pitch, shifting their focus, addressing a gap in their business model before going back out to market. That information is critical. And there's often times when I get a no, and I will go back and probe and ask for why or what you were looking for that wasn't provided, because that learning is invaluable.
So that's a really good point. And this is, we started these office hours sometime during the early periods of COVID. Obviously, everything was in Zoom. So virtual office hours of giving founders an opportunity to pitch us without the pressure of actually pitching us. So this is a qualitative feedback session, not necessarily an actual pitch session. Mm-hmm. And the intent was to get founders the experience that they need in making those pitches. And many a times, I think there are a lot of investors that are willing to give their time in this manner. And the best way to do it is go find people that are not at the stage that you need the money in, mm-hmm. but are within the sphere of your vertical or industry. So, if you are a pre-seed or a seed stage, go to a contact or find someone within a Series A, Series B segment and be like, look, I don't need to pitch you. You're not in my, sort of stage, but I'd love qualitative feedback on my pitch.
Yeah.
Now you can potentially walk away from that meeting without pressure, but actually listen mm-hmm. To how you can improve. So that's another thing that we also do that quite often for founders, because we believe that that's the best way to give back to founders who are looking for that feedback, who might not get that from actual investors who are evaluating them.
Yeah, it's a gift. And I would encourage any founder to take advantage of that type of feedback and opportunity. From your perspective, what can a founder do to increase the likelihood of you having a desire to invest?
So there's a lot that goes into making a decision on investing, right? So one is about understanding the sector, understanding the macroeconomic environment within that sector. Mm-hmm. We don't ever presume that we know more micro level than the founder, right? That's absolutely, if we ever feel like we know more about this than the founder, there's a fundamental flaw in the whole equation at that point in time. Mm-hmm. So we always look for the founder to be an expert of that space that they're pitching. We may have a macro view about it, but not at a micro level. So we're looking to learn. So one of the things through the conversations, whether that's a level 1 or a level 2 call for us, is about gathering insights about the industry and then getting comfort about the founder knowing enough about the industry also.
Right.
So that's really where we end up getting more and more engaged and lean in on. There are industries that we know nothing about, but we learned through the process. And then it's about timelines, right? It's about understanding where is the founder in their fundraising timeline. If it's a topic that we are fairly comfortable in, it's very easy for us to come in sooner with a decision. If it's a topic where we need to learn a little bit more about the industry, we're going to need some time for that. So does our timeline and the founder's timeline overlap? It's about understanding that upfront. I think it saves the founder a ton of time. And we've passed on really good companies purely because of this reason, because it'll take us 4 weeks to get to a decision or a move to a next level on this, because we have 2 other deals that we're just about to close on, and there's a bandwidth issue on our end. Yeah. And the founders' timelines were different than ours. And we said, look, we love what you're working on, but we genuinely do not have the bandwidth to engage on this business right now. Let us close these deals and we can come to you. But if that's not going to work for you, then there's nothing we can do as such.
Yeah, not all investors are as forthright in terms of their pipeline and their timing and their availability, and that's why I encourage founders to ask the questions up front, because
very important.
Both of you to make sure it's the right fit in the right stage of the company and stage of the fund.
So just as a sort of major outline, right? Every VC fund will have potentially 2 internal sets of meetings, right? One is your preliminary review meeting, and then there's a deeper level review meeting. The first one is about triaging deal flow and about quick yes, quick no, move on, next kind of process, and then and the second one is a little bit more in depth, where it's either an associate or an analyst presenting the deal opportunity to the partner, if it's a multi-tiered structure. If it's not, if it's just a one-person operation or a very flat, just partners operation, even there, the partners need to sort of explain to the other partners why they are presenting this as an opportunity. Find out their schedule, find out what their process looks like. When do they meet in the week to discuss this? And what's the traditional outcome of those meetings? What's the next step from that meeting? Typically, every firm will have a process pretty well defined, because they have to do this again and again and again. Mm-hmm. It's as you said, Jackie, it's about asking those questions and getting that understanding so that you again sync up on timelines. So we have a process every Thursday. We review pipeline, and the ones that pass, by Friday evening, we let them know that, look, this is the reason why we pass and why it's not going through. Or we give them feedback on, here's what was discussed. Here are the areas of questions or concerns that we'd love some more data on to understand. Either you can provide us or give us, we're going to go find the data ourselves. Mm-hmm. So usually by the end of the week, we like to give that response back.
That's great.
Question for you, actually, now coming out of so we spoke about meetings, we spoke about, taking a meeting with an investor, what gets you in front of an investor, post-meeting etiquette. This is very important for us as investors, but I'd love to hear your perspectives on it. What do you think, what has your process been post-meeting early on in your, I'm not saying Series B, obviously, because life is very different once you've sort of reached that point, but let's say your seed, pre-seed rounds, what was your typical process post-meeting?
So always follow up with a thank you, but more importantly, if there were open-ended questions or information that the investor wanted, to follow up on that so that you don't leave it open-ended. I think it's critical to close the loop there and to align on what next steps are in their mind so that you aren't confused. And that helps to force them to give you the information as to, look, this is our timeline. We're going to review internally. We'll let you know by this date. Otherwise, a lot of investors won't provide that information. So I think using that post follow-up to be respectful, to follow up with any open-ended questions, and then to align on what next steps are, if any, are critical.
That's really valuable. And we've had quite a few instances where founders don't follow up after the meeting and they just sort of move on to the next one. And that sort of leaves you thinking, what's the engagement that this potential founder will have with you once you've made the investment? And that's why we like to sort of engage with founders in between rounds, because that's when you recognize and understand, how are they in follow-up? How are they in actually engaging with you when there's no real need? Because otherwise they're looking for the check from you, and after they get the check, well, are they going to tell you to get lost, or are they actually going to engage with you meaningfully enough?
Yeah. One thing that I do post-investment is every quarter, I have to present to the board, but I will take a version of that information and prepare an investor communication so that they have a sense of how the company performed in the last quarter, what we're focusing on, what successes, what challenges we've had, so that investors feel that they're in the loop, even if it was a minor check and they're not entitled necessarily to financial data. I think that's really important for maintaining transparency and keeping them engaged.
You just hit on something that is a pet peeve for us. Is this, as business starts getting a little bit busy, founders tend to drop on engaging with investors and providing the feedback. Because the reality is, look, we're a fund. We have LPs to respond to. We got to put together our quarterly updates for our LPs. And just think about it. Fund 1 was 31 companies. we have to synthesize, qualitative and quantitative data of 31 companies to put together in one report for LPs, right? It's exhausting. And then if you have to spend 3 weeks chasing founders to get updates, that's absolutely annoying.
Yeah.
So, just sort of understanding, okay, what is the fund's LP, reporting cycle? Does that fit with your cycle? So typically what we do is we like our founders to send us updates by the end of the first month of every quarter for the previous quarter, so that by the second month of every quarter, mid-month, we are able to send out an update to our LPs.
Yeah.
And that gives us 2 weeks to synthesize 31 company updates.
Yeah.
It's a lot of work.
It's a lot of work. And I think being able to synthesize the critical elements of the business, not just the good news, but the challenges as well. I have found, as a delightful side effect to that, when I talk about challenges in hiring or critical roles that we need to fill, investors that I don't normally speak to sometimes just reach out directly with a great lead or a suggestion. Yep. And so there is a lot of value in being able to tap those resources and get guidance from your investors, even if it's outside of the normal cadence of communication.
Yeah, portfolio company asks is a very, very important sort of metric for us. We actually have in our CRM a separate area where we only log requests that have come in from portfolio companies for introductions, for anything of that, hiring, and all of that. And then, we also have a Slack only for the founders of a portfolio that help each other out. So, whether that's legal connections, whether that's, we had one founder that was interviewing legal firms for her large Series A, and she put together an Excel spreadsheet after speaking to all of them and shared it with this 59 other founders that we have in the Slack group, and every single one has benefited. So, I think that there's a lot of this about portfolio company asks that as a fund, we try to sort of help, and then we leverage our other founders to help the other founders. And again, they all have a financial interest in each other through us. And so there's obviously a far better engagement level than there would be otherwise. But yeah, I think portfolio company asks, as you said, to your investors is a really important opportunity for founders to, get the benefit.
I think with your equity model of giving all founders equity in the fund, you've devised a uniquely brilliant and insightful way to be able to create alignment of interest and getting the founders to help one another. It's fantastic.
Yeah, we were pleasantly surprised at how well people received it, and how the impact of that has spread. So we're very happy with it.
Good. I hope other investors are listening.
So next question for you. How much of your time do you think you spend on fundraising, number one, and second on just a long-term relationship management with investors versus running a business?
Okay, so that answer varies depending on whether we're raising a round or not. There are times, for example, raising this Series B in this macroeconomic environment, it was by far the most challenging raise I've ever been through. The level of scrutiny, the time that it took, the level of diligence, it ended up taking probably close to 80 to 90% of my time when things got pretty heated. And that's why it's critical that I have an operating partner who can manage the day-to-day, because the founder is expected to be the one driving the fundraising efforts. And, there were hundreds, if not thousands of meetings that were needed, because not only do you have to start with a large pipeline, but every fund that has interest probably goes through 5 different meetings before you get to the point of starting to discuss terms. And those are diligence meetings, and they all take time. So I don't think you can underestimate the amount of effort and time that's going to be required of the founder in doing this. So it's critical that as a founder, you make sure that your employee bench is filled with the right leaders that can fill the gap when you have to step out.
That's a very important point about having an operating partner, someone you can lean on. And it's real, right? If you're raising money from someone, the expectation is that the investor is going to get to speak with the CEO. And you're right, the due diligence, number of calls and number of engagements, they sort of scale with every successive round. I think pre-seed, seed, we've capped ourselves at 3 calls. We will not do beyond 3 because we believe it's not fair for the founder. And which means between the call number 2 and call number 3, there's a lot of work that we do on our end because we feel like if we are interested, we have to carry a lot of weight ourselves. And we might ask the founder things in emails in between, but we will not take a full call unless we are ready with a lot of research and a lot of data before call number 3, because call number 3 is the last call we will take with them. But again, as you said, it changes dramatically when you go into A, B, and C, and D would be even more torture at that point of time, I would assume.
Is there more that you can tell founders about what to expect during the diligence process and up to closing the deal?
So diligence in itself, it changes with every round, right? So the benefit of a pre-seed and a seed round from an investor's perspective is I don't have financials to do diligence on, right? So I'm not looking for fraud because you don't have anything, right? There is no company, there's barely anything for me to really diligence. So it takes a huge chunk out in terms of having to focus on that. I think on the founder, there's just pure focus on the founder, on who they are, what they're doing, and how we can sort of understand their background. So we will engage with previous investors of the founder if this is not their first time, if this is their second time. If it's their first time, we'd like to engage with potential people that they've worked with in their past. We'll look for within a network to find someone that has engaged with them that can sort of speak about them as people. And so there's a lot of focus on people. We've had some interesting outcomes of background checks. So we do deep background checks on every founder. We also hire a PI at times. Even though this is pre-seed and seed, we'll do that, and we'll do criminal background checks. We'll do all of these things. And we had some interesting ones pop out in a couple of them that we had to sort of raise it to the founder, saying that, look, this looks a little shady, and do you have something to say about it? We had one where the founder was, when we did a background check on him, came out that he had some domestic abuse arrests. And we were like, whoa, do I really want to invest in someone with that kind of background? But I did not feel like just passing for this and lying about why we are passing, because we're like, the easiest thing to do is just wash our hands and move on because we have 800 more companies to look at. And we didn't feel that was a fair thing to do. So we actually raised it with the founder, saying that, look, this is what has come up. And based on our processes, this will be a concern. Do you have anything to say? And he burst out laughing. I was like, what the hell, right? Like, I just said something that's quite meaningfully impactful. And he's like, yeah, I get pulled aside at TSA every time I enter the country, at immigrations, because there was an identity issue. And they're like 2 people with the same name, same birthday. It's actually a different person. So, we ended up investing in him after that when we actually validated that they were 2 different people. So a lot of focus on the person. You got to be willing to be vulnerable. You got to be willing to be honest about all of these things and share what is real, because we are looking to get to know the person. The reality is 80% of my portfolio is going to fail. That's a big number. That's a really big number. And so there are many founders that have failed, and we have willingly said, I'm okay with the fact that the business failed for X, Y, and Z reasons. The next company you start up, I'm investing. Because it's the founder that we're investing in. And we really appreciated what work he did and how hard he tried or she tried to make it work. And so it's that. You just got to be willing to be vulnerable enough with the founders and with the funds and share with them.
Yeah, agreed.
Awesome. You guys, this has been such an awesome conversation. I mean, I've heard you guys talk so many times, and I still learn something every single time. We're going to open up to Q&A. So for those in the audience, please submit your comments and questions in the chat, and we're going to bring it up to our guests. The first question is from Jonathan, and it's for Sanket. How do you calculate your risks? And I believe that
Oof.
how do you calculate risk?
Risk is what we live by in seed and pre-seed, and as I was just telling Jackie, we expect 80% of our portfolio to fail, and so from a fund perspective, recognizing that and accepting that is key, and not losing sleep over it. In fact, the ones that are zombies are the ones that really become bothersome, because they're not growing extensively, neither are they finishing off. And so you end up in this position where you want to help them, but then this is not really going anywhere. And so that situation is a little bit painful. But to give you very specifics, when we invest in a company, the metrics that we're looking for is this: can this be a fund maker? And that's really the way to look at it, because the intent is, and that obviously there are a lot of variables to it, but at least at a macro level, is the TAM big enough? Is the opportunity size big enough? And can this founder potentially take it to a certain scale that gives us that return that we're looking at? So you got to figure out what is that for each fund that you're raising money from, right? So if we're, fund two, $30 million fund, and we write a first $500,000 check with an ability to follow on. But at least at that first check level, we look at it from this perspective. Can this do a 60x? If it's a $500,000 check and a $30 million fund, 60x is what we're looking for. Can this do a 60x? If it can, if there's at least the business potential of it getting to that, that's really the way we will look at it. Then we're going to say 80% is going to fail, and then 20% is where we will potentially put in more effort, and a smaller percentage of that will actually do follow-ons on. So risk is a slightly more complex perspective, but we have a full modeling that we have to do when we have to present to our LPs on how we think of risk.
Mm-hmm. So I wanted to throw this question to Jackie. So like as founders, founders never think that their companies are the ones that are going to be the biggest risk, right? That will bring that kind of risk to a founder. What have you learned throughout your different fundraising rounds in how you present your company in a round to make investors feel comfortable in your company and not think that you're the one that will carry all of those risks that might, make them feel like not wanting to invest in you?
Well, I think as you frame your pitch, and it's a living, breathing document. I think that's first and foremost. And every conversation you have with an investor and every question they ask, you learn where their interests lie, and you augment and change your either messaging or the deck to address that. But most critically, I mean, everybody who's read What are the Basic Fundamentals of a Pitch Deck, it really does address that question. It's what is the opportunity in the TAM? Be able to articulate that in a way that makes sense, understand the math. Secondly, what is unique about what you have built to de-risk your business going forward? I think that's the most important thing to be able to articulate is what have you built as a competitive advantage? Is it your technology? Do you have patents? Do you have any exclusive access to a peer-to-peer insurance policy with Geico? These are the things that are really critical to be able to articulate and why they are such critical barriers to entry. Being able to paint that picture, because as Sanket said, an investor may have a macro view of an industry, but they're never going to have the level of nuanced understanding of your specific business than you are. And you have to know that and be patient and able to explain it in a way that's easily digestible in a first conversation without getting too technical and using business speak and jargon that doesn't really resonate. So being able to articulate 1, 2, 3, 4, 5, what your competitive advantages are and how you have de-risked your business is critical.
Awesome. No, this was great. I think we were very complimentary comments and answers. Next question that we have is, how do I handle investors who try to exercise excessive control? And I'm curious to hear from the founder side, right? But also through the investor, maybe seeing peers that have been like that, or horror stories. I want to hear from the two of you.
PTSD is kicking in. This goes back to being thoughtful about making sure you are taking money from the right individual, and that number one, first and foremost, there is alignment on the vision and the direction you want to take this company in. If not, shame on you, you shouldn't take their money. Desperation is not an excuse. And I think also being thoughtful about where your skills and strengths are and your depth of knowledge, and identifying and being honest. Founders, sometimes it's hard for founders to identify where their weaknesses are, but being introspective and being very honest gives you such an advantage as a leader, and being able to bolster the team around you to fill in those gaps. And that applies not just to your team, but to your investor base. So I will seek out a strategic investor that I know has certain expertise in the marine industry or with marketplace and product expertise, because being able to tap into those resources only helps propel you in terms of your strategy and what you want to do. And then it's okay for them to be involved, but you have to be selective about who you want around the table and for what reason.
That's a very fair viewpoint, and I think from an investor's perspective, we've had founders that have. So we invest pre-seed and seed, and then we've seen really onerous term sheets show up at Series A, Series B, Series C, and as early investors in the company, we've engaged with the founders saying, "Don't take this. This is absolute torture, and you can read it. You can see it in the term sheet. When an investor is putting these onerous terms in the term sheet, that there's going to be some pain coming with it. It's just that you're not going to, yeah. Mm-hmm. You have to see it at the point in the term sheet, because the only thing the founder is seeing is the dollars on top and not necessarily everything else. They're like, no, we'll manage the rest of it. No, you will not. Those things will come and bite you so bad that you will regret the day that you took this term sheet. But it's all there in the term sheet. They can't be, the beauty is an investor cannot be onerous without terms allowing him or her to be onerous. So effectively, it's there in the term sheet. You just have to know what you're looking at. Yeah. The plain vanilla term sheets will not give them the opportunity to be onerous. They can be influential, but there's a difference between being influential and onerous on you. So I think that's the balance that you have to always look for, and there's enough science for it upfront.
Yeah, well said.
So talking about term sheets, something that as Endeavor we see founders being very worried about is valuation. And sometimes they're even more worried about the valuation than the actual terms of the round, the terms that are being negotiated. What are your thoughts on this topic? And when is the right moment to talk about it? How to present it? How to navigate this as you're still, if your focus is still fundraising? Exactly.
I'd like to start with that one. Honestly, I think if a founder is so caught up in valuation, especially at early stage, it's just naive, super naive. Your goal and your role as a CEO is to make sure this company is funded and has the resources to grow in order to enable your vision to come to life. Getting caught up over valuation is a fool's errand if you're looking at that over the terms and the controls that these investors are going to have. And so my advice is be smart about it. Look at the comps in your market. Understand, for example, we're a marketplace. I understand how valuations are determined in a marketplace. It's a multiple of revenue, not GMV, not EBITDA. And your valuation is the multiple changes depending on your growth rate. And then do you have positive unit economics? And do you have a CAC to LTV ratio above 3? Like, these are inputs that all influence valuation. So if you have a founder that's completely myopic on this one metric and not willing to do the homework to look at what is fair and market for their industry and their segment, and not look at the broader terms on the term sheet, I think they're only harming themselves.
Well said. And what I would add to that is it's a function of the headlines that you see on the local newsletters and on LinkedIn and on Twitter. If everyone is being driven by how much the other company has raised, then that becomes the number that everyone chases, that they just want to sort of chase the valuation and they chase the raise. I think that it's also a function of the fact that as private companies, you're not sharing your sales numbers. As public companies, you get purely valued on top line performance. And so let's do an analogy of public market, private market. In public markets, you have the CEOs that are driven by a quarter-to-quarter performance because their stock options are linked to top-line revenue numbers, and they sort of only think of short-term performances. The real good, strong, solid public limited companies give their CEOs long-term benefits, not short-term. And so therefore, they are not swayed by stock performances and whatnot. It's the same thing out here. I think the problem is the startup ecosystem is driven by what valuation did you raise at. And so I think the narrative needs to change also. We need to get away from solely focusing on the valuation that people have raised capital at. And that'll sort of change people's perspective. But as Jackie said, I think you got to get burnt at least once to really recognize the value of what's right, what's wrong. We have a CEO in one of our portfolio companies. This is his third business, and he's just heads down focused on it, right? Not one press release on the rounds that he's done. And he's at a Series C now. And he just not one press release at all. His press release is only about product launches. And he goes really hammer and tongs on product launches. And that's it. And again, so he's like, look, I've matured beyond the point where I need to be valued based on what the valuation of my term sheet was. I want to be valued based on what my products are doing in the market, how many customers are talking about my product. And so he's driven based on that, and he's performing based on that. So I think it's a little bit of the narrative also that's driving behavior.
We can have a whole conversation about hype and movement as a collective community on like how much valuation these things are valued, right, versus actual, like you're saying, product launches and developments in the business. So, but this is for another day. We have one last question, and is, what do you think founders can do to prepare and protect themselves from one round to the next so that they don't create issues when they take money at a pre-seed or seed round that will, bite them afterwards all the way to Series B? So both you, Sanket, as an early stage investor, and you, Jackie, as someone who has raised so many rounds, what can they do at early stages to make sure that they're setting themselves up for success? And
Rebecca's
I think I
frozen.
froze. Yeah. Were you able to hear my question?
Yeah, we got the question. So from my perspective, if you think about term sheets that you take
Were you
for
able
a
to
seed,
hear my question?
Yes. So the term sheet that you take in a seed round will have an impact on your Series A. Mm-hmm. The term sheet you take on a Series A round will have an impact on your Series B. Mm-hmm. If you're only going to think about this round, you're not going to recognize the impact that it's going to have. It's the same thing as a fund manager. When I'm fundraising from LPs and I'm pitching them, I'm not pitching. There are some LPs I'm pitching them for fund 2. The reality is they're not going to invest in fund 2, but I'm lining them up for fund 3. And I need to do this to line them up properly. If I do this right, they will line up for that one without me having to work on it. The same thing goes with founders taking a term sheet in any round. You have to look at, if there's a new term sheet coming on top of this, what are the rights that I'm giving away here? And that multiplied by 2 or whatever, how will that look in the future on the cap table? Yeah. That's really what it is. So, the plain vanilla, you can stay. The market has a traditional plain vanilla, set that you can work with those. Try not to let that deviate. And if an investor is coming with a term sheet that's extremely different from that, be cautious. It's going to have a lot of riders and a lot of impact into your next round.
Yep. Yeah, just to reiterate, there are standard VC terms. And as a founder, you're not expected to know or understand all of this. So get good legal counsel and trust your legal counsel. And then this may sound naive, but I think the best thing you can do to increase your valuation and protect yourself, get that attorney to do a standard term and just grow your business. Because the more you drive growth, the better your terms are going to be in the next round.
Yep, and I think there's also a fundamental play with lead investor, follow investors. And so, if it's about finding out if you're getting a lead investor, do they have standard term sheets? You can ask these questions as Jackie was asking those earlier questions. You can throw into the back of those questions also. Do you have standard term sheets? Mm-hmm. Even before you get down to a call 3, call 4, you've started figuring out whether they fit into your funnel or not.
Yeah. The other thing we did was we made sure that at the various rounds or tranches within a round, that all preferred was treated the same. There were no unique preferences at any different stage of investment. I think that's critically important. Yeah, I would reiterate that. If you can maintain that, I think that's important.
Great. Well, I know I lost you guys there for a second, but I'm sure everyone heard the answer to that. Wanted to thank you both for joining us today and for sharing your unique perspectives. There's so much to learn from your experience, and I'm so happy that the audience was able to see that and to relate to a lot of the things that you had to say. So, on that note, thank you both for being here. And we also want to thank everyone in the audience for attending and our sponsors, Dell Technologies and EY, for their support. The Endeavor Masterclass series will be returning next month on October 11th with a session on term sheets. So if you'd like to learn more, please visit endeavormasterclasses.eventbrite.com, and we'll see you then. Thank you both, and we'll see you next time. Bye.
See ya. Bye.